Hey, good morning once again, options traders. Well, we got a great question from one of the traders in our group last week asking about when should you roll out options? And she said it was a difficult question because there's a lot of things to consider. And she's absolutely right. That is one of the things that makes it a tough decision because you've got so many moving parts. And this is why it pays to understand your options theory. However, because there are so many moving parts, I'm unable to do this all in one video. It would just be too long. So I'm going to break it up. I'm going to start with at the money options, and then we'll look at in the money and out of the money. So let's start with the first question. Should you roll out at the money options early? So let's go find out. And as always, before we do, please be sure to click like and subscribe. Always very much appreciated and definitely helps to promote the channel. So first of all, definition, what does it mean to roll out? We've talked about this before, but these terms come from the layouts on your broker's platform. So we have the strikes running up and down. We have the months across the top this way. So anytime you are moving to a different expiration, you are rolling out. So if you had the 90 call for January and you wanted to close it and move to March, that would be rolling out. You're keeping the same strike, you're just moving to a longer dated option. Now, if you were going in the other direction, that would be rolling in, if you were coming from March to January. So we use the terms in and out to refer to time. And of course, we use the terms up and down to refer to strikes. Up meaning that you're moving to a higher strike, rolling down that you're moving to a lower strike. So for these videos, when I talk about rolling out, it is assuming that you are keeping the strike the same, but you're just wanting to switch to a longer dated option. Well, another thing to consider is that all strategies involve trade-offs. We've talked about that before. There's no way that one strategy can completely dominate another strategy in all respects. Otherwise, that would be an arbitrage. It would be free money waiting to be picked up. So there's always some kind of a trade-off, some kind of pros and cons, and that's really what the decision comes down to. And for that reason, one trader might say, yes, it's advantageous to roll, while another trader might say, no, it's not. And both traders could be correct because they're just looking at different trade-offs. So when it comes to the rolling options, remember that all strategies have trade-offs. And that's true whether we're talking about at the money, in the money, or out of the money. So that's why we're going to cover them separately. So again, we're going to start now with rolling an at the money option out early. My first comment there is that there is little reason to roll out early for an at the money option. And there are several reasons. First one is that your deltas are going to stay about the same, at least for a fairly narrow range of that stock. So if the stock goes up a little bit, in both cases, you're going to have about the same deltas. Stock goes down, you're going to have about the same deltas. So you're not gaining a delta advantage. However, if you keep the shorter dated one, the one that you currently have, if that option goes in the money, your deltas are going to be greater. And that means you have more profits to pick up if you are correct that that stock in fact goes up. And also another benefit, if that same option falls out of the money, your deltas are going to be lower and you're going to lose less. So you're really picking up all of the benefits just by staying where you are. So for the pros though, if you had to name some, by rolling out in time, you will increase your vega, your sensitivity to volatility. However, most people are not trying to do a sensitivity adjustment to vega because you would need a really big pop in volatility to make a relatively short option trade to have any kind of an effect. And if that were true, there are better ways to play vega. So even though that's true, you could make an argument that you're picking up vega. It's not really a good argument for going, let's say, from a 30-day option to a 60-day or 120-day. Just not going to make a big difference. Now, you will also decrease your theta by going to a longer dated option, but as we're going to find out, it's a little bit of 6 of one, half a dozen of another, because it's also going to cost you more. And also, as we've talked about, theta is not really a risk, it's a characteristic of an option, because risk always has to do with uncertainty. But time moves in one direction at one speed, it's 100% known. So to say that you want to roll out to a longer dated option to manage theta would certainly not be a good idea. But probably the biggest of all of the cons for rolling an at-the-money option out early is that you're increasing the price. You are moving from whatever the value of your current option is, you're having to pay more money to roll it out in time, and yet you're not really gaining a lot of benefits. So for example, let's take a look at a pricing model. I used a stock of 120% volatility and no interest rates for an at-the-money option. So our strike is also at 100. Notice the deltas for a 30-day option compared to a 120-day. They're about the same, 51 delta compared to 52. Big deal. Rolling out to the 120-day is not going to give you a big difference in your deltas. What about the thetas? Well, yes, we had a 4-cent theta minus 0.04. This means that for the next day, 1 day's passage of time, this option is expected to lose about 4 cents. Whereas if we moved to the 120-day option, we would be expected to lose 2 cents. Well, as before, this isn't really a risk, it's a characteristic. But part of the reason that you're getting this relationship here where it's cut in half is because we've doubled the option's price. Remember, there's an option pricing principle, the square root pricing rule that we've talked about before. If you increase the time fourfold, going from 30 to 120 days, you double the option's price. And we've gone from 228 to 456, or about 457. So you can see that, yes, you did decrease your theta, but you've also doubled the option's price. That's really the reason that you've cut this in half. So is it really a benefit? I wouldn't really say so, because again, you've now got more money at risk. Look at your Vega. Yes, you do increase Vega that I talked about. That would be maybe one reason for saying to consider rolling it out. We've gone from 11 to 22. And what that means is that if volatility moves up one tick, let's say from 20% up here to 21%, this option is going to pick up 11 cents, whereas the 120-day option will pick up 22 cents. However, again, you have to say 22 cents on a base of 457 versus 11 cents on 228. And so, of course, in percentage terms to your option, that's going to be exactly the same. So you have to say, is that really worth putting more money on the board to double your Vega? I would say definitely not. But here's the biggest risk. You've moved from an option that's currently worth 228 to one that is now worth 457. So to roll out at this moment in time right here, you would have to spend another 228. And yes, you could roll from the 30-day to the 120. But what did you really gain out of it? So let's look at both of these options for a range of stock prices with the current curve. And if we did that, this is our 30-day option in blue, and there's our 120-day option in red. So again, what we're looking at are different stock prices, and we're looking at the current curve for an at-the-money option. This is a $100 call with the stock at 100, and this is the 120-day call with the stock at 100, right there. So you can see this range. The blue and red lines virtually overlap. That's showing that the deltas, or this slope, are pretty close to equal. You're not gaining a big delta advantage by rolling out with the stock down here at the money. And if the stock does rise, look at this, you would have been better off to stay on the blue curve with the 30-day option, because the blue curve sits higher than the red. Why is that? Because these deltas have gone to 1 much sooner, because there's almost no extrinsic value, whereas the 120-day option still holds a little bit of extrinsic value. So it's going to underperform if the stock, in fact, really makes a big upward move. What if it moves down, moves against you? Well, same thing. The 30-day option, the one that you're currently holding, will lose less. And again, that's because it costs less. In this example, it was 228 versus 456 or 457. And that's why we've got a difference of 228 between them right here. So think about that. If you stay put with the 30-day option, you haven't really damaged your deltas. If the stock does go up, you end up with more profits. But if it goes down, you end up with smaller losses. So the advantages, if any, are not coming from directional movements. It's not coming from your deltas. It's not coming from your gammas. You're going to be better off staying put rather than rolling out. Now here's another look at this information. We're going to take the prices in red minus the prices in blue. We're going to look at the difference between these two. So you can think of it this way: if one trader has the 120-day call in red and another trader has the 30, and we were comparing them, saying what are your differences in P&L across different stock prices, this is what we would have. And look at that, right at zero. There's not really any advantage to rolling out. But if the stock goes up, we end up worse off by rolling out. That's what we saw before, because you've got less profits. You've got a more expensive option, so it's retaining some extrinsic value in there. And if the stock falls, you could potentially lose more. In this case, it was about the 226 difference. And that's what it would cost you to roll out. So again, the main point to take is that if you have an at-the-money option, let's say you bought it with maybe even 6 months to go, and you're now down to the last 30 days, and people, they start to panic and they say, well, I'm used to having 4 or 5 or 6 months on this option. I'm down to my last 30 days. So before we go off the steep time decay curve, which is not really a risk, remember that's a characteristic, they want to roll it out. And there can be times where that can make sense, but not if it's an at-the-money option where the stock equals the current strike price. So that's the first thing to cover for our first video. If you are holding an at-the-money option, I would not roll it out unless you want to get really technical and start talking about Vega characteristics and other things. But even then, there are better ways to tackle Vega than just rolling out a long option. So I hope that helps to at least answer that question for the at-the-money options, and we'll cover the others in future videos. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.